Very good afternoon to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India, I welcome you all in today's webinar organized by WSP of ICI. Theme of the today's webinar is very important: risk assessment and responses to the assessed risk. We have so many standards in that. SA 315 and SA 3330 both are very important under the heading risk assessment and responses to assessed risk. In order to tackle these two very important standards, we are having with us our own from own chartered accountant fraternity, very learned speaker, C. Amit Mitra ji. So, on behalf of WSP of ICI, I welcome you, sir, on this webinar organized by WSP of ICI. Welcome to you, sir.
Thank you, sir. Thank you.
I also welcome all the participants of today's webinar. So before we formally start, it is my proud privilege to share with all of you the brief profile of our today's learned speaker, C. Amit Mitra ji. Amit ji is a senior partner with MSKA and Associates, has over 24 years of rich experience in audit and accounting services to domestic and international clients. An ardent speaker in various forums, he possesses rich exposure of IFRS, a lead partner on several listed and large multinational engagements. He has excellent exposure in the implementation of internal financial control framework. He is a joint leader of professional practice group PPG of the firm and is head of the audit and accounting quality management for the Indian firm. He is a special invitee to the Audit Assurance Standard Board since 2019 and part of subcommittee of working on SQM1 and SQM2. He is also a peer reviewer and a technical reviewer contributing to the FRRB of Institute of Chartered Accountant of India. He has contributed by the way of various lectures as well as the webinars, seminars, and virtual CP meetings on various platforms of the Institute of Chartered Accountant of India. During COVID period also, he has given so many virtual CP meetings and various webinars on the various auditing themes organized by various platforms of the various organizing units of the Institute of Chartered Accountant of India. So without wasting much more time, I request CM Mitra ji to please deliberate on the topic on SA 315 and SA 330. Over to you, sir, please.
Thank you, Anil. Thank you, and good afternoon to all my friends and colleagues. Thank you for having me here. And I do understand this is a very complicated topic. I will try and crystallize this with some key aspects, with some key examples. And also, I'll try and pick up certain things which are contemporary and which have found place in regulatory orders. I will just put up my share my screen. Anil, if you can confirm my screen is visible.
Yes, sir. Yes, sir. Make it full screen, sir.
Visible?
Yes, sir. Fine.
Okay. Sure. Thank you. So frankly, if you so just starting by deliberations, and before I move on to the next slide, if you ask me these two standards, which is SA 330 and SA 315, these standards are the heart and soul of our audit profession as it dwells on how the risk is to be assessed. And all of us on today's webinar, we understand ourselves to be experts, but yet we've seen so many failures, so many audit failures through the review of our regulators. These two standards have now started finding place in the regulatory orders. It is extremely important for us to understand what these standards talk about. They are very lengthy standards and fairly complicated. My endeavor is to put in certain case studies, to put in certain examples through NFRA, but there is no substitute to reading the text, or there is no substitute to reading the literature given therein. So it will be a mix of the two. Please feel free to share your questions after the deliberations. Okay, so before we actually move on to 315 and 330, this is a snapshot of all the standards on auditing applicable issued by ICAI, which deals with risk assessment and response to the assessed risk by the auditor. So SA 300 to 499 primarily we'll talk about risk assessment and response, as I've already mentioned. SA 315, which is identifying and assessing the risk of material misstatement through understanding the entity and its environment. Now, this standard deals with auditors' responsibility to identify and assess the risk. So I say auditors' responsibility to identify and assess the risk of material misstatement in the financial statements. Now, whether it could be due to fraud or it could be due to error or through understand. But how do you do that? So it is done through understanding of the entity, its environment, and including the internal control. We will dwell upon this much in detail as to, it is easier said than done. I mean, these two sentences say a lot, but how do you actually do it? What is the prescribed method as per the standards on auditing? What is the kind of documentation we are required to do? We'll all dwell upon that. Then moving on to SA 330, which is the auditor's response to the assessed risk. Now, those risks are assessed in 315. The auditor's response is captured in SA 330. Now, this standard focuses on the response, and it provides a guidance on how the auditors should design and perform audit procedures in response to the identified risk. Besides that, of course, in this slide, you will see SA 450, it talks about evaluating the effects of misstatements identified during the audit. Now, the standard addresses the auditor's responsibility regarding what needs to be done wherever you have assessed misstatements. Then, of course, there are standards on how the materiality is to be determined at the planning stage and at the performance stage of the audit. And then what do you do if there are significant changes subsequent to the audit? How is materiality impacted? We are not going to cover that. Our focus will be on 315 and 330. The reason why I'm giving this flavor is that you should know from where these things are originating and what all is available with the institute in terms of dealing with the risk assessment. These standards, along with the other standards, are part of, as I said, are part of standards on auditing issued by ICAI, which provides significant guidance to the auditors in conducting a high-value audits and an effective audit in assessing and responding to the risk. Okay. Yeah. Now, as it mentioned that it provides the SA 315 provides a guidance to the auditors on how to identify and assess the risk, material misstatement. How do we understand the entity and its environment? What would constitute an internal control? What kind of valuable insights an auditor is expected to know before they assess or potentially assess the risk, and then how it needs to be tailored. This basically would be covered in 315. So if I read the definition of what is the objective given in the standards on auditing, I will read this. Please listen to this very carefully. I will read very slowly. Now, the objective of the auditor is to identify and assess the risk of material misstatement. Now, everything needs to be demonstrated on your documentation too, right? I read it again. The objective of the auditor is to identify and assess the risk of material misstatement, whether due to fraud or error, at the financial statement and assertion level. And I will have certain slides on what assertion level would mean. Now, coming back to the definition, at assertion level, through understanding of the entity and its environment, including entity's internal controls, thereby providing a basis for designing and implementing response to the assessed risk of material misstatement. Obviously, this will help the auditor to reduce the risk of material misstatement at an acceptable low level. Now, the expectation clearly is that whatever is given in the standard, you are able to tomorrow demonstrate to the regulators or to the peer reviewer or to anyone who's entitled to inspect your files. Now, gone are the days where the assessment of risk and understanding used to happen only through one round of verbal discussion with someone in the entity. It could be a CFO, it could be a finance manager. Now it is expected that whatever is given in the standard we are required to follow that in toto and demonstrate that also. So this slide primarily gives a brief snapshot of what constitutes or let's say what is covered in SA 315. As you can see, there are 8 components to it: risk assessment procedures and related activities. This will again have some 4 components. We will dwell upon slightly on these. The second one is the required understanding of the entity and its environment, including the entity's internal control. Components of internal control. Now, this is one area where, basis by my discussions with many practicing chartered accountants, for some reason they are kind of not very converged with how do you what do you make out of components of internal controls. What is the kind of, because they believe the client is not maintaining any such kinds of record, whatever is required as per the framework, which is the inspiration is drawn from OSO framework. I will spend some time on the control environment. I believe that is extremely important. Tomorrow, from the understanding of the entity's perspective, addressing the company perspective, and also from the perspective of documentation which could be needed to be demonstrated. Okay, now moving on. The first one, so you would see the first one here was risk assessment procedures and related activities. What I've done is I have hashtagged each of them so that we are able to correlate back to this slide. And this is the crux of 315. I'm trying to make it slightly more simpler. Now, how does the auditor perform risk assessment? This particular slide would kind of guide, and there is a plethora of literature available within the standard auditing. This is what goes into that. Now, there are what procedures is an auditor expected to arrive at, or let's say to perform the risk assessment. Now, it could be through inquiries of the management, which in any case, I think almost all 100% of auditors would in any case be doing. Now, inquiries of the management would also include all those people within the entity or system who would have a greater understanding of the company or greater understanding of the processes or components, which would give greater insight about the functioning of the company. One may also look at performing analytical procedures. I'm sure all of us are aware of what analytical procedures are, but still, just to fine tune what should form part of analytical procedures, there is a slide ahead. Then observations and inspection, and then what is the previous experience of the auditor? Previous experience in terms of previous experience of the auditor in the similar industry, or dealing with the accounting issues, but obviously the experience of performing the audits as well. Okay, so now inquiry procedures. Inquiry will be with those charged with governance. Inquiries will be with, as we had mentioned, it could be employees, it could be with in-house legal counsel, it could be various departmental heads, and even inquiries with the internal audit function as well. No one's stopping us to have our inquiry procedures with the internal audit function, internal audit teams. Analytical procedures, as I mentioned, so generally our understanding is that this is a financial term, and then analytical procedures would mean just a variation between, let's say, the budget versus actual or previous year versus current year, and try and identify the differences and then map it with the understanding. So from a understanding of the company perspective, it doesn't really stop at financial information. It does. You are also required to do a lot of non-financial information understanding, and we'll come to that. And then the idea is the idea of performing these procedures is that it helps in assessing the risk of material misstatement. Unless and until you know the industry, unless and until you know what is an unusual transaction, what is an unusual item in that particular industry, and then narrow it down to the company, you will not be able to understand what misstatement would really entail. Moving on to observation and inspection, I think we all are already doing it. The idea is to pen down now. Now, observations could be on the entity's operations. Observation would include go and have a visit at the plant site, have a discussion with the plant manager, have a discussion with people at the plant, and try and corroborate your understanding what you have gained with the finance team or with the other stakeholders. You inspect your documents, you inspect the larger strategies or the business plan, you inspect the records, and then obviously the important aspect is that you will have to have a deeper understanding of the internal control map, which basically talks about the culture of the company as to what type of corporate governance the company has, or what type of corporate governance they plan to achieve. And obviously, what is the kind of reporting done to TCWG? When I say TCWG, I mean those charged with governance. So basically, reporting from the management to the board, or and what is the basis on which it is prepared? Is it prepared by let's say the books of account, which is Excel, which is Tally, or the trial balance and all? Or is it independent of what is the books of account? One needs to understand the culture. One needs to understand as to, so all these things will form part of your observation and inspection, primarily to understand the culture of the company. Okay, now, so from auditor's perspective, auditor need to identify the risk of material misstatement, both at the financial statement level, which is, let's say in a layman language, it is at an overall basis, and in auditing language, which is pervasive, which is all pervasive. Now, what could be all pervasive is, let's say, what is the budgeting process of the company? How is the going concern risk assessed? What are the laws and regulation? What are the controls? And what could be management override of control? So these examples could be examples of all pervasive. And then risk management at the assertion level as well. Also, assertion level, as I mentioned earlier, I do understand that not all understand what assertion level would mean. I have certain slides. I've tried to crystallize the assertion level from the management perspective and from the auditor's perspective, and then try and link it with how would you do your control assessment. Primarily, in a simple language, assertion level would mean the class of transactions, let's say an account balance or a disclosure, or a single line item. We are still on element number 1, which is identifying and assessing the risk of material misstatement. This slide primarily talks about the identification of risk carried through the process of obtaining an understanding. I think we've built as to how do you gain understanding of the entity in our previous slides. And then after the understanding is obtained, then the risk identification process and evaluation process has to happen. This will happen at the financial statement level and at the assertion level. This also we've discussed. And once this process is done, which is the identification of risk and evaluation of risk, then then you wear your auditor's hat and identify and pen down as to what could go wrong in terms of at the assertion level and also at the overall level. And after that, consider the likelihood. What is the likelihood, which is again dependent on the magnitude of that and how material the amount is. These 4 points would primarily then close the risk management process. Moving on to the second element, which is understanding of the entity and its environment. More or less overlap. You would see there is some overlap from one to another. But once you start penning down it, you will actually get to know the linkage. So it's not overlap, it's a linkage. It's a straight flow of the risk assessment process. Now, here it talks about, it further dwells into what the understanding will entail. Understanding of what? Understanding of relevant industry, understanding of the regulations involved. Let's say if it is an NBFC company or if it is a financial service company, there are additional regulators which are involved, which is an RBI. If it is, there's a lot of foreign investment or funding coming in. There is FEMA, there's RBI, central bank involvement. You will have to identify, you have to understand and identify what are the regulatory requirements which are involved therein, and what are the external factors which are applicable in the financial reporting aspect. External factors would mean, just to give an example, if there is a branch outside the country, and then let's say, for example, there is a branch either in Russia or in Ukraine. So there are significant external political factors which are involved. You need to have an understanding, because then only you will be able to identify your risk and then plan your procedures accordingly. I think the nature of entity operation we built upon, governance structure. Also, these days, what is catching up is, in fact, it was already there in our standards on auditing and code of ethics, is the deeper understanding of the ownership of the company. Who's the ultimate beneficial owner of the company? I think as an auditor, it's time we should have complete clarity. In fact, PMLA Act of Auditors, chartered accountants are now part of that, where we are expected to know the sources of funds of our bank. Okay, so now again, the understanding would entail the entity's selection and application of accounting policies. How is accounting policy selected, and what is the entity's objective strategies, and then linking it with the business risk, and then the entity's financial performance. This is, I mean, if you look at, I have deliberately put this slide because this actually gives a very nice snapshot of the understanding of the entity divided into internal sources and external sources, and financial and non-financial. In our previous slides, though, we have already covered that, but let us try and see this matrix. So financial information and internal sources, what would that be? It could be the financial statements, it could be the budgets, the internal reports, financial performance, the income tax returns, judgments, and other estimates. So this was internal sources and financial information. Now let's look at financial information and external sources. External sources, obviously, as the name suggests, it is outside the company. Let's say industry information, which is kind of generally available on the internet. Then competitive intelligence, credit rating agencies, what are they to say about the industry or about the company, and then the media and other reports. So anything which is external from the financial information perspective, it is expected that auditor would have access or would have gone through this in order to establish the understanding of the entity, which in turn in the longer picture is identifying and assessing the risk. Now let us look at the non-financial information. Non-financial information, internal sources could be vision statement, mission statement, objectives and strategies of the company. What is the organization structure? Minutes should show a lot of non-financial information. The job description of the people, the policies and procedures manual, non-financial performance parameters, things like that. It is expected, I'm sure, and basis my discussions with a lot of you, this is one area where we probably tend to ignore. based on the fact that these are all non-financial information. How will this impact my trial balance? How will this impact the profitability? This will help you build up your understanding of the entity and its environment, which in turn will help you assess the right kind of risk. Let's move at the last bucket, which is non-financial information and external sources. Again, it could be news articles, information on the internet, trade associations. So anything which is non-financial and external source gets covered here. Anything which is financial and external source gets clubbed on the above bracket. This is, I think I've kind of just segregated this separately. We can move ahead. The last one probably is important for our understanding, which is the measurement and review of financial performance. One should also have an understanding, because this will give you the insight as to how the people are measured in terms of their performance. Are there any incentives, or are there any pressures which may invoke them to let's say, incentives for fraud or something like that. Let's say if there is a incentive given to the CEO or the CFO, and those incentives are linked to the net profit of the company. It is a clear linkage. It is a clear incentive for them to show a higher profit, which in turn, from your perspective, and you being professionally skeptical, you are expected to pay more focus on all those judgmental areas. Let's say provisioning of AR, provisioning of inventory, all those unnecessary write-backs flowing out of the creditors or the APs, things like that. And then even for that, the assumptions given in the actuarial valuation, whatever could have an impact or significant impact on the bottom line, it will actually trigger from here. You would get to know that there is an incentive, so you need to pay focus. In my view, this is the most important function in SA 315, most important element in SA 315, and most, let's say, misunderstood, or let's say people don't have deeper understanding of what this is. I will try and share some examples, because I believe it is very important for us to understand these 5 elements, because you would see its inference being given in most of the regulatory reviews now, which means now they have a deeper understanding of the internal control framework, internal control components, whereas in our documentation we continue to struggle. Okay, so let me. So what exactly is control environment? So by definition, control environment refers to the overall attitude, awareness, and actions of an organization and its management regarding internal controls and their performance in achieving reliable financial reporting. Obviously, it's very complicated. They have added many words, and then they've come up with this definition. Let us look at the examples, and then we'll try and understand as to what this will actually cover. Examples of control environment factors as per SA 330 would include, and obviously this is not an exhaustive list. I'll probably share some 4 or 5 examples, and then move on to the next one. Tone at the top. Now, this is a fit case of what the control environment the company is having. Now, tone at the top, which means the ethical values, the integrity, the commitment to competence, which is demonstrated by the top management, and how is the tone at the top set for the entire organization. This is one example where you would want to know how the control environment is. The next example could be the, let's say, human resource policies and practices. What is the hiring policy of the company? What is the training policy? And how is the evaluation of the employees done? Is it based on the competence? Is it based on favoritism? Is it based on, is there enough integrity that foster a strong control environment? This is again example of human resource. Another example could be management's philosophy and operating cycle. The organization's approach to the risk management, how do they approach that? I mean, are they happy to follow the laws of the land, or they believe in shying away and then brushing away all the non-compliances and move on? What is the emphasis on controls? What is their attitude towards correct financial reporting, accurate financial reporting, and compliance with all the internal controls and the control environment within the organization? These probably would be some examples of which could be covered in the control environment. I think one or two more I should cover. Communication and enforcement of policies and procedures. This is also important. What is the kind of oversight and what is the kind of communication? Is there a two-way communication? Are employees even communicated of the code of ethics of the company, the existence of comprehensive policies and procedures along with the effective communication and the monitoring, and how strong they are? One thing is that you just put it on the pinup board and just leave it there. And another thing is that there is a proper follow-up, there is a feedback obtained from the employees, there are actions taken, there is a, let's say, whistleblowing mechanism available. If someone wants to escalate a matter, they are allowed. There is a free communication for the management. Is management open to all those things? This talks about the culture. Ethics requirement, I think I've talked about. Moving on to the next one is the entity's risk assessment process. Again, this basically refers to the method and procedures used by the organization to identify and assess the risk that may affect the achievement of its objectives, including reliable financial reporting. Okay, so let me explain this by examples. The entity's risk assessment process may include risk identification. I think we slightly touched upon there, but now here we are talking about the entity's risk assessment process. Now, risk identification. Now, how does the organization do the risk assessment, risk identification process? And organization can do this by conducting an exercise such as the risk workshops, which is extremely common now in companies having high governance. It could be done through interviews with key managerial personnel or reviewing industry-specific risk factors. So there has to be some method through which a risk identification process is done and it is demonstrable. The next is once the identification is done, then is the risk analysis. The organization evaluates the identified risk to determine their potential impact on the achievements of its objective, which is again, that is how you would evaluate. So once you have identified, you have analyzed, then you have to evaluate. The evaluation would mean the organization evaluates the identified risk to determine whether the potential impact on the achievement of its objectives. This evaluation may involve prioritizing the risk based on the potential consequences and likelihood. I mean, everything what is identified and analyzed can't be kept in the same bucket. I mean, you have to evaluate as to what is more relevant for your organization, which will have a larger impact or potential impact on the achievement of its objective. This analysis needs to be done. And the next one, the fourth one, is the mitigation strategies. After we have evaluated the risk, the entity generally should develop the strategies and controls to mitigate or manage the identified risk effectively. And then once this is done, then is logically you would want to monitor it also. How do you monitor? The entity will establish processes or controls to ensure that the risks are mitigated. There would be control activities, there would be internal audit function is one of them, or there could be segregation of duties. All those things would come into the monitoring. And then obviously in the end, you would want to reassess also. Let's say based on the monitoring, you feel that there is one particular activity or there is one risk which continues to be there and it is not covered basis the evaluation or basis it still is not mitigated. You may want to reassess and develop or add some more additional controls there. And all this needs to be documented. everything and anything that I'm saying needs to be documented and demonstrated first to yourself. The team has to do it and demonstrate it to you as a signing partner before you sign any entity. And there is some leeway for smaller entities, but let's not go into that. The idea is to really understand the spirit of these two standards. And once you start documenting probably one client, two client, on the third client, you will see yourself uh, the need to see this document before you actually go and for necessary sign-offs. Okay, now moving on to third one. Yeah, information systems and communication. Again, there is, I mean, you talk to, basis my discussion with my colleagues and friends. This is, kind of again mistrued as I mean, they ask one question: what is your accounting software? The client responds that our accounting software is Tally, and that is the end of the internal control component, information system and communication. It doesn't stop there. In fact, if you read this, you read the standard, they have dealt in such a nice manner. They will so they have given you as to what are the right set of questions we should ask. So let's say, for example, IT infrastructure I've mentioned above. The auditor should have an understanding of the organization, information technology infrastructure, including the hardwares being used, the software, the networks, and the database. How is it processed? What is the kind of storage, retrieval on the financial and non-financial information? And just adding to this, it has now become more relevant and significant with the introduction of the MCA circular coming in on the audit trail and the backups, which the expectation is that the backups have to be taken on a daily basis. And then there are circulars both on the auditor's side as well as on the company side from the compliance perspective. This has gained significant, and if I am actually reviewing this particular component on any of my audits, I would actually want to see a response on the audit trail in this particular element, and what is the company doing on the daily backups part. Segregation of duties. The organization establishes control to segregate incompatible duties within its information system, such as separating the responsibilities for authorizing, recording, and reviewing the transaction. I mean, this is extremely common. This is fine. I think we do our vouching does capture this in the right spirit. There is, wherever there is no segregation of duties, I think I have seen a lot of issues being raised by us. Now moving on to access control. Here the organization implements controls to restrict access to sensitive information and systems, ensuring that only authorized individuals can access and modify the data. Let's say, for example, why would you want to give access control to access control of, let's say, a sales record to the purchase manager? There is no need. So let's say, why would you want to give access of passing a journal entry to let's say a cashier? So things like that. Whether there is adequate controls, adequate access controls there. This is one very important aspect where we should have a deeper understanding, because you would want to know what unusual transactions are sitting inside this software, and this to reach to that, this is one important element. The fourth one is data integrity and validation. The information system incorporates control to ensure the accuracy, completeness, and validity of data, such as data validation checks. There has to be reconciliation and exception reporting. And then the reporting system, what kind of reporting system is being, we should have an understanding of that. How is the communication channel the organization establishes? Is there an effective communication channel to facilitate the flow of information and instructions between different levels of management? It is also extremely important, because you don't want that there should be a breakdown of, or there is a breakdown of communication channel, and the MIS probably that management is preparing, and there is no backup to that. There is no, because there is no communication channel, there is no backup. MIS is moving, MIS by the management is moving in one direction, and the recording done by the entity, or let's say the process owners, is moving on a different direction. You don't want that. You would want complete transparency. You would want a complete you would want a comfort that the communication channels are there and they're working fine. And then there are policies and procedures to report if there is a breakage in the communication channel. Management information system, I think all of us are experts in that. There is, whether there is adequate management information system, is there a system where management gets to know, and what is the timing of the management getting to know of any business activity? These examples probably will demonstrate the importance of a robust information system and effective communication system within an organization's internal control environment. An organization with well-defined information system and clear communication channel can enhance the reliability of financial information and effective risk management. So you would see that everything is finally, getting connected to how you would assess your risk. What exactly would you do? What exactly would you document? What are the questions? What are the procedures you are required to follow? Moving on quickly, control activities. Again, what exactly is what do you mean by control activity? Obviously, I've mentioned certain pointers there, but let's say by definition, control activities are the policies and procedures established by an organization to mitigate the risk identified during the risk assessment process. So again, what is the quality of segregation of duty? Whether the role, when I say quality of segregation of duty, there could be segregation of duty, but same person who's performing the segregation of duty could be allotted many roles. There you would want to see whether it is effective or and it is effective. It is there and it is effective. Moving on, authorizations and approval process. So once you identified that there is segregation of duty, the organization would want to know that the transactions and activities are authorized by the appropriate individual based on the predetermined levels of authority. Segregation of duty is there, but is it done by an appropriate individual? Does the individual who is approving the process is capable enough to understand what he is approving, or it is just a checkbox exercise? It is just a process in place, but he doesn't understand. So this is some qualitative aspect on that. Physical control, I think this is simple. This basically talks about the restrictions in the access either to the sensitive information or even to the safeguarding of the assets of the company. Reconciliation and review. So there has to be a demonstration of a review being done by someone, which gives the comfort that the process is there and it is working fine. IT controls, I think I touched upon doing that, and documentation and record keeping. I think there is no, it will form, you will find this everywhere. So you need to do this well. If you don't do this, then you have not done anything. Then you will not be able to demonstrate that you have actually understood. Please. Monitoring of controls. Again, it would entail management's review, whether there is a regular review that takes place by the management, whether there is a design and is that operating effectively from the management review perspective. Please feel free to ask these questions to your management. They can't say that, just have the trial balance and do your audit and move on. And go on other days. This is there in the standards of auditing. You need to get comfort on the controls on how the management is reviewing the process. You need to, because this will indirectly give you comfort on the internal control environment, which will indirectly give you comfort on the culture in the company on their focus on the controls. Another monitoring control activity is the internal audit function, whether there is an internal audit function, what is the periodicity of the internal audit function. Then the self-assessment procedures, which include regular evaluation of the controls by process owners, whether this activity is there, because they are the best person, they are operating those controls, they are the best person to identify and also to let the higher ups know that this area will need improvement. Obviously, the bottom understanding is that they are ethical. And then exception reporting. There are many softwares, both through data analytics or through manual access or through Excel, but one should have a deeper understanding as to what exception reporting is. What is an exception in a particular report, and whether there is this reporting which highlights the deviation from established controls or threshold, and how is management reacting to that? I mean, one is that you prepare an exception report and then keep it in the door, and that's fine. No, is there a management follow-up to that? And is this demonstrable? And then the continuous monitoring, which means what has been, how has things changed post the exception review, and what is the fallout of those exceptions? Does it need a change in the control activity? Does it need a change in the way the control processes are built up? That all would form part of it. So you see, these examples demonstrate the importance of ongoing monitoring activities to ensure that internal controls are operating effectively, and they address the control deficiencies promptly. Now, address the control deficiencies promptly. This is important because this will tell you the culture in the entity or the organization, that their focus is there on control. And obviously, I mean, if it is not there, then what is the impact? I mean, someone may say that would you then straight away jump to your auditor's opinion and would you qualify? The answer is no. But I mean, you would then want to be 10 times more cautious while doing your audit, because you know that the controls are weak. So there could be a huge risk of management override. You would want to be more professionally skeptical. This will alert you more because the weaknesses are there. Okay, now this is the fourth activity. We moved on to next one. Sources of potential risk of material misstatement. This is a summation of this. So understanding of the entity, I think we have spent enough time. PAR is preliminary analytics review. This, I think analytics is also being covered earlier. In two sentences, this is identifying the unusual transactions, and from those unusual transactions or unusual movement in the balances, either from budgets or from the previous year, basis the understanding that the auditor has obtained from various inquiries and observations done by the bank. And all this needs to be documented. All this, the understanding that you have obtained basis your client meetings or basis your information that you have obtained, basis your, when I say client meeting, I mean meeting with the process owners, meeting with the CFO, meeting with the finance team, meeting with the factory managers, plant heads and all. And then you try and build up your corroboration as to how the figures should move, let's say from budget to the current, or let's say from previous year to the current now. And then another source of potential risk of material misstatement is client meeting. I've already built upon entity level controls, which, you know, those 5 factors, control environment, entity risk, we just covered those. External information we covered. And then one of the important things that the regulators are expecting. So why I'm saying regulators is that they, I mean, to be honest, and between this group, the primary objective is to get the comfort that the audit team, including the engagement partner, understands the entity, understands the risk identification process, and basis that identifies what are the risk of material misstatement. One is this, and then it needs to be documented. The other is that tomorrow, how do you demonstrate this? And what the regulators are also now looking at is that whether this, let's say, a fraud discussion or all these things are discussed amongst the team members also, or and then are you able to show it to them? Because They don't want to encourage that this was, kind of just a paper thing and it was not known to the people who are actually sitting on the ground. So this is again an important document which it has to be there in your file. Okay. Okay, I talked about in my earlier slides about the assertions, and I do understand that most of us really do not understand the linkage between the assertions and the risk, and the demonstration of that in your planning phase. So assertions are primarily divided into two categories. One is the assertion level at management assertions at management representation level, and others is assertions from the auditors level. Now, the use of assertion in representing that the financial statements are in accordance with applicable financial reporting framework. Management implicitly or explicitly makes assertions regarding primarily below elements in the financial statements related disclosure. One is obviously the recognition. The other is the measurement, how you measured it. And third is the presentation and disclosures of various elements, including the amounts and disclosures in the financial statement. So these three are management assertions. Management will have to represent to you as auditors that basis the financial statements and related disclosures. They are comfortable with the recognition, they are comfortable with the measurement and the presentation and disclosures of various elements. So from the auditor's perspective, the assertions are primarily divided into three categories. One is the class of transactions, the other is the account balance level, and third is the presentation and disclosure level. These three levels is where the auditors would mean what assertions would be. So let the classes of transactions, this primarily would include occurrence of a transaction. Now, I know that so I'm not going to really dwell upon what occurrence or completeness or this these assertions would mean in detail. My only objective of putting this slide here is just wanted to link this as to how this is broken and how you would document, how would you segregate this into the categories. So on the class of transactions you will do it on at the occurrence level, on the completeness, the accuracy, cutoffs, and the classification. And then at the account balance level, which is primarily, when we say account balance, primarily, let's say at the period end level, it will be existence, whether the assets, liabilities, or equity, interest, whether those exist, whether there are rights and obligations, whether the entity holds or controls the rights to assets and liabilities, completeness of all assets, and then the valuation and allocation of assets. Class of transactions, primarily, you would see more related to the P&L items where occurrence, whether the revenue has occurred, whether the revenue is complete, whether the revenue is accurate, are the cutoffs proper for the year end, and the classification is appropriate or not. Presentation and disclosure, primarily whether the presentation is complete, whether the classification and understandability of financial information is appropriately presented and disclosed, and then the accuracy and valuation, financials and other information is disclosed fairly and appropriately. Okay, so I just wanted to cover this through certain examples of what potential risk of material misstatement is and what auditors are expected to commonly are expected to encounter in more frequently. So let's say a revenue recognition. Now, what could be the potential risk of material misstatement there? I mean, it's very simple. There may be a risk of overstatement or understatement. Example I told you, I mean, if there is an incentive given to a CEO or or a CFO, there are high chances that revenue may be overstated, or it could be understated. If they have already met the targets, they may want to push the revenue to the next year. So, I mean, this is one area where there could be a potential risk of material misstatement. Inventory valuation, again, I mean, at the end of the day, valuation will involve a lot of judgments. They could use an inappropriate accounting method, or inappropriate uh, valuation techniques could be used. There could be uh, slow moving inventory, but they may not have really provided for. Uh, these are judgmental areas where you could have a potential risk of material mistake. Accounts receivable, again, flowing from revenue, there could be overstatement of accounts receivable. You may not have fully provided for the doubtful debts. Um, the collection could be an issue which may not have been provided for by the management. Again, AP, I think, simple inadequate controls over the recognition of liabilities. Financial statement disclosure, there could be misleading disclosures. Let's say, for example, there is a huge related party transaction, and these have been picked up by NFR's very recent review. The auditor was expected to ensure that the related party transactions are there, and then they are complete and they are in compliance with the accounting standard, which was not done by the auditor. They've kind of taken it as an observation. Management estimate. So wherever there is an estimate, which means that it is not as simple as recording an invoice for repair maintenance. It is an estimate. Estimate could have judgmental errors, which from the auditor's perspective is a potential risk of material misstatement. Again, on the internal control side, I mean, there could be deficiencies or weakness. So management override of control, I mean, this is, in any case, this risk is mandatory. This is non-rebuttable. I mean, it needs to be taken. The reason for this is that controls could be overridden. So this is always a risk, not even potential, this is always a risk. Okay, this primarily, we now move on to the next hashtag, which is 5, risk that requires some special consideration. I think this is simple. I mean, auditor would need to assess where, so after doing all this, all the first 4 steps, the auditor would actually get to know whether substantive procedures alone would be sufficient, or he needs to do more. Now, what is that more? Now, when we say substantive procedures, primarily, it would mean test of details, which again, in further simpler language, would mean you pick up the vouchers and start testing its underlying documents, try and link it with the assertions now. Have you ensured completeness of that particular account balance? Have you ensured whether the transaction has occurred? Have you ensured accuracies and all those assertions, the cutoffs and all? You try and link it with your testing. Now, basis all whatever the auditor has now understood now, whether substantive procedures are sufficient. Now the standard is clear that now it says that there could be a situation where the auditor believes that the account balance, could be incomplete, or it could not be, or it may be not, it may not be recorded fully. Now, in that situation, there could be a risk on the controls as well. So an auditor may want to understand, may want to do a deeper understanding, and also work on other areas, which is substantive analytical procedures, or it could be extensive manual controls, automated controls as well. Okay, now moving on to the revision of risk assessment. Many people have this confusion that once they do the risk assessment, once they complete the planning phase, they should not be revising the risk assessment. Now, what the standard says is that you could actually do a risk assessment. You could actually revise the risk assessment. You could modify it also, and further plan your audit procedures basis your audit evidence, and basis your performance of audit, that you have moved from planning stage to the evidence gathering stage. There is no problem. That's what the standard says. This basically, again, part of the fifth element, significant risk. Now, it is important for, I just kept the definition here because I think we are all experts in identifying risk. And one of, few of those risks are considered as significant risk. So significant risk primarily is which requires special audit consideration. An auditor needs to exercise professional judgment to identify the risk that requires special audit consideration. Auditor shall exclude the effects of identified control on the risk. I mean, frankly, if you ask me, um, more from a documentation perspective, this is important as to what have you considered as a significant risk, and the expectation would be that a specific and special focus has been laid down on how you address a significant risk. But if you're signing the financial statements, my personal view, I mean, all the risk needs to be addressed adequately, and you, being the signing partner, needs to be comfortable as sufficient and significant work has been done in all the areas. This basically is a matrix given in the standard, basically talks about that where the impact is high and the likelihood is high. I mean, those have to be considered as significant. As I will, in the interest of time, I will actually move forward. Now, risk that requires special consideration and identifying the significant risk. Again, as per definition, these risks are significant risks are often relate to non-routine transactions or judgmental matters, and generally they are high in value. The size or nature or the occurrence of the frequency is infrequent. The size is high, and these are judgmental matters, non-routine matters. I mean, if you have a routine, non-complex transaction, then this is not a significant risk. I'll give you an example here. So generally, all of us do this journal entry testing at towards the end of the audit, and then we select certain criteria basis which now those criteria are for the unusual transaction, mind you. Basis those criteria, we get certain output from let's say the day book, and we've seen in many situations where the journal entries are running in hundreds and hundreds. Now, how could those hundreds and hundreds of journal entries be unusual transaction? Now, this is a clear indication or a clear case where where what is unusual, that is not defined properly. Unusual transactions can't be 1,000 entries. Unusual transaction, that means the identification of what unusual, that is wrong. That is not so. So this is one example where it basically flows from the sentence that if it is a routine, then this is a routine transaction. This could be a non-complex transaction. So unusual transaction, I mean, there is no ballpark numbers, or don't quote me anywhere, but maybe a 40 or a 50 or a 60 transaction, depending on the size of the company, it will vary. But you will not have many unusual transactions. Let's just leave it at that. And then moving on is that what is significant non-routine transaction, which is primarily where there could be greater management intervention to a specific accounting treatment. You would get to know that management intervention is high. You may want to know what that is. Greater manual intervention of data collection and processing. Manual may ho sakta hai. Complex calculations on some accounting principle. You may want to understand as to what this is. It could be a sham. And then the nature of non-routine transaction. I think I've went on this aspect. Okay, now moving on to sixth one was primarily risk for which substantive procedures alone do not provide sufficient appropriate evidence. I think we had covered that. I mean, if substantive procedures do not cover alone, the auditor should get into other activities like analytical procedures or automated controls on manual. Moving on to the seventh one, revision of risk assessment. I mean, of course, risk assessment has to be a demonstration that risk is being assessed and revised periodically. Now, there could be certain controls on which reliance was placed and which were or which may not be operating effectively now, either because there is a change in the person or because there is change in some process or the other. So you may want to do the revision in the risk assessment process. Documentation. I think this has to become the auditor's favorite tagline now. Anything that you do, be it planning phase or be it understanding of the entity, understanding of the business, or whatever we've discussed in last 30 slides, document it. It can't be a one-pager document. There has to be a deeper understanding category-wise as per the standards on auditing. I mean, I can't really dwell more on the importance of documenting in today's day and age. Obviously, when you look at the last line, and if a key or significant aspect of audit is performed, but it is not documented, I mean, the verdict is very clear. It is out there on your internet box. It is not audited. You can't have a situation where if it is not sitting in your archived files or if it is not forming part of your audit documentation, and then you present it later to the regulator or to anyone, they are not going to accept it. The verdict is very clear. It's out there. Now it is up to us to ensure that we document everything. We do a good audit. All of us do a very good audit. But unfortunately, we fail to demonstrate that we actually did some work. We actually did some good audit. I think this slide I wanted to put, and I stressed upon this in one of my previous slides where we talked about discussions with the team management. And then I had said that the regulators are looking at this particular document in your file, wherein they want to see that whatever is your risk assessment, whether have you discussed with the team, whether there has been an engagement team discussion, and whether those questions have been discussed, whether the team members are aware of the planning of what discussions, what should form part of the audit risk, what is the broad risk, what is the timing of the audit, what is the response to our risk, what is the materiality used in the financial statements, who are the key people in the company, what are the key areas, what are the key controls, is there an internal audit system in this, who performed the previous engagement, what were their observations. So all those things need to be documented. There has to be, the agenda has to be there, and then you have to actually discuss it, then put it in your files as to these items were discussed amongst the team. Okay, so now with this background of 315 of those entire 8 components and the documentation part, if now we move to essay 330, which let me move on to the next slide first. So this is the transition slide wherein it says let's say this is the movement from 315 to 330, wherein we have already now designed and implemented the audit risk, and appropriate responses of those risks are to be given by the auditor now. Now, what is required? I mean, it looks simple, obviously. It looks very, very simple that, I mean, risks are identified, we will perform those test of details, done. But no. Now, if you look at what is the requirement, it says the auditor is expected to maintain professional skepticism. Unfortunately, this is one area where most of the auditors have not been able to demonstrate how they have been professionally skeptical. And the auditors have hounded on to us on this particular aspect, which is flowing from 330 to maintain professional skepticism while we perform our audit. And for the benefit of all of us, I have picked up certain live examples from NFRA latest review where they have commented on auditor not being professionally skeptical. I will come to that. So before you're performing a test of details or while performing a test of details, it is expected that you will maintain professional skepticism. Your team will be an experienced team members. The staff will be experienced staff members who understand, who have the skills and the expertise to perform the audit, who understand what the audit is, what the expectation is, who have attended your planning team meeting. And then it is expected that you will build in the elements of unpredictability. And I understand that again, this is something which is probably we do not do in our audits or we do not understand. I have 3 or 4 examples in my ensuing slide as to what would constitutes an unpredictability and how you should document that. So again, then once all these are addressed, then you perform the test of controls. Test of controls could be in the form of manual controls, or it could be in the form of automated controls. It could be a combination of both manual and automated controls. And then once the controls are done, then you actually get to know uh, that what is the controls involved, are those controls running effectively. So there is a design of control and whether it is operating effectively. If the design is there and if the controls are effective, controls are operating effectively, it gives you sufficient comfort for you to, let's say, slightly reduce your test of details. So it's a combination of, how would you perform what would be your audit program. And then at the end of the day, there would be a combined approach between controls and the substantive procedures. And then once the tests are done, then you evaluate whether basis the assessment of the risk of material misstatement at the assertion level, and then you conclude whether are you okay with the results or would you want to qualify or disclaim. Then you have a complete basis that this is what I had thought, this is what I had done, and this is my result. I am not comfortable, and hence I am giving a disclaimer of my opinion. Now, moving on to the previous slide, um, I just want to run through the objective. The objective of SA 330, objective of the auditor is to obtain sufficient appropriate audit evidence about the assessed risk under 315 through designing and implementation the appropriate response to those risks. So this is primarily is the expectation, and now you know why 315 is connected with 330. What did we do there in 315, and what are we expected to do in 330? What are we and then again, as I had mentioned in this slide, that be professionally skeptical. This particular sentence is being picked up from SA 330 by our regulators. Okay, now if you ask me, this should be this slide should open our eyes. I know all of us would have already read through, and all of us would have felt kind of frustrated as to, I mean, there was no audit procedure required or left in our files. But then the regulators are saying that auditor was not professionally skeptical. So let us try and understand as to what exactly issues were, and then what is in there, what is in store for us in the future if our files are put up for inspection by NFRM. Okay, the first one is future failure to investigate significant increase in revenue. Now, in this case, what had happened was the auditor overlooked a staggering 1,000% increase in revenue from operations between the previous year and the current year. Now, this alarming increase should have triggered concerns about potential material misstatement or fraud in the revenue recognition. Now, unfortunately, the auditor failed to address these red flags indicating negligence, and this was taken very, very seriously. This was taken as a very negative point in the NFRA order. Now, I mean, no one can defend this. I mean, if you have a more than 1,000% variation in the revenue and still it doesn't alarm the auditor, and then the order goes on to say that the auditor should have been more professionally skeptical. I completely agree. Completely agree. These are the red flags which, I mean, you won't find a direct audit procedure to this, but then the professional skepticism, how would you come out of that? Okay, moving on to the next one. Improper audit planning and non-understanding of the entity. In this case, the auditor was charged with inadequate planning, failing to comply with certain standards. The auditor file lacked documentation regarding the understanding of the company's business. The company का business समझ में नहीं आया उसको. The engagement partner generic checklist and work papers did not adequately reflect the specific risks and complexities associated with the company. Now, how basic can this be? Obviously, there was some certain things which were documented in the audit file in the name of the understanding of the entity or the company. But when the regulators actually did the review, the inspection of that particular file, the nature of business itself or the understanding of the company was completely different than what was documented in the audit file. There's no justification to that. Okay, moving on to the third one. Now, in this case, the joint auditors failed to review the unusual events in the financial statement. Now, in this case, there were lots of issues, and this is very frequent. There were lots of issues in the financial statements. One of the issue wherein the reported amount was 10 crores of fraudulent transaction. Now, this was already reported by the company to the stock exchange. The auditor also picked that up and put it in the audit, put it in their auditor's report. Whereas there were many other larger issues, hundreds and thousands of crores of issues already existing in that. Partner ignored the other indicators pointing to the abnormal state of affairs of the company, having adverse implication on the true and fair of the financial statement. Now, this basically is a clear demonstration that the team failed to display the professional skepticism. Moving on to the next one. Now, in this case, the auditor failed to exercise professional judgment and professional skepticism in the audit of transactions of over 6,000 crore, where the entity entered into a group company which was owned and controlled by the entity covered under the review. Now, this transaction should have been declared as a related party transaction, but the company failed to put it in the related party, and so did the auditor. Auditor did not point this out. Now, such a huge amount not being pointed out, I think we need to be more professionally skeptical. A company A recognized, moving on to the next one. Now, in this case, certain miscellaneous expenditures were written off, and the balances, miscellaneous expenditure and sundry balances constitute about 55% of the total expenses, which were about 3,000% higher than the previous years. Again, they picked up from the variation analysis, and then they said that this was a red flag which should have been picked up. I mean, the auditor must remain skeptical and then challenge the management views. This is what we need to adhere to. This is what is expected to be demonstrable in our files. As I mentioned in my earlier slides, wanted to deliberately pick up certain examples of unpredictability. Now, let's say in case of a manufacturing company, the audit team has always conducted, how do you build in unpredictability? I've given an example where probably in a manufacturing company, the management would expect that the audit team will conduct, or let's say will observe the existence of inventory at the end of the year on the last day. Now, what could be the unpredictability procedure here is that you please change your date. I mean, you do your in observation of inventory verification either 10 days before, 5 days before, 7 days before, or let's say sometime after the 31st of March. Then you would actually get to know, catch them unprepared is what basically we're trying to say. Now, this unpredictability basically it allows the auditor to gain a more accurate understanding of the company's inventory control. The idea is that, are you comfortable on the inventory, on the company's inventory control, and then are there enough risk and mitigation to those risks within the system, and are those working fine? Another example could be where the auditee or the company would expect you to pick up high value inventory items for physical verification. So along with them, probably you may, as unpredictability procedures, you may want to, probably pick up certain items which are of low risk items, just to ensure whether the robustness of internal controls on those items is all through or not. So these are some examples of, there could be many other examples. I mean, other examples of could be from an employee perspective. You may want to verify the, let's say, the existence. When I say existence, verify whether those employees exist in the company or no. You may want to either talk to them, or you may want to verify their PAN details, or you want to verify their taxation details, so things like that, which these procedures are slightly different from your normal routine procedures. But in terms of giving comfort, I think it gives a huge comfort. Now, audit procedures from from the assessment of risk of material misstatement at assertion level. As I had mentioned earlier, from auditor's perspective, there are three categories: A, B, and C at the transaction level, classification level, and at the class level. Now, what is important is that the auditor's assessment of the identified risk at the assertion level, and then the linkage with the work performed. Now, again, this is slight reiteration. You could do it through test of controls, but only test of controls is not sufficient. You could do it through test of details. Test of details in small organization, only test of details is okay, but you should still have an understanding, and to demonstrate the understanding, a walkthrough should be done, has to be done. And, or you could do a combination. You could have a combined approach of using both test of controls and substantive procedures. Test of controls, moving on, this is just a reiteration of what we discussed. Primarily, after the risk assessment, the controls could be first get the comfort on the ITGC environment of the company, and then once you have comfort on the ITGC environment of the company, then get comfort on the control activities, comfort on the functions, and particular process, the automated controls built therein. If the auditor intends to rely on automated controls, there is something called a RCM, risk and control matrix chart, which is a summation of control activities and processes and the controls built therein. The risk, it is a mapping of control activities and the risk, and then how is the control functioning. It could have a combination of both manual controls and automated control. I think the templates of this are given in the ICOFR guidance note. One should have a look at that. And then besides that, other entity level controls, which we had initially, I think, talked about, entity level controls are also required to be understood. Entity level controls would mean the controls over management, use of budgets, observing management's comparison of monthly budgets with actual expenses, things like that. So it starts from the ELC, which is the entity level controls, then it comes to the ITGC environment, then it comes to the control activities. I think I'll move operating effectiveness. We've dealt upon this. This, I think, also we have covered automated controls, talked about the processes. Okay, now I think this is important. What if the control testing was already performed in the previous year? Now, the frequency of the performance of controls by the entity during the period, it depends on the length of the time during the audit period that the auditor is relying on. So how much has been the length of the time? So in one of the paragraphs, it basically talks about that. If everything remaining constant, which is the expected rate of deviation in the control is known, and if there is no deviation, and if relevance and reliability of the audit evidence to be obtained regarding the operating effectiveness, if that is also constant, and then the automated controls could be tested once in a period of 3 years. This is given in one of the paragraphs, and then uh, from a manual control perspective, I think there has to be a clear documentation as to what is the degree of reliance degree of reliance on manual controls that the auditor may want to consider, and the test of controls. What is the weightage of test of controls on an overall basis? Automated controls, obviously, if the test of coming back to the manual controls, if the reliance is more, then you may want to do more testing. And when we see more testing, it depends on the frequency or the performance of the control by the entity. And the length of the time I've already told you. From an automated control perspective, if one control is operating fine, and if the logics are well defined, or the tables and files or other permanent data used in the program has not changed, then you do not need to do more than one, because it is just the use of the software. If one output is same with the same logic, the other output is also will also be same. Yeah, so this is the second para which I was talking about. If there have not been such changes, then the auditor shall test the control at least once in the third audit. But my personal view, restrict this to automated controls, manual controls. It will be very, very difficult for auditor so one can still do that, but it will be difficult for the auditor to justify, because there could be change in the employee. Even if there is a change in the employee, someone may question that the person who's operating that manual control, that person has changed, and hence you should have performed the testing. But as far as the automated controls are changed, everything remains constant. And I think this once in 3 years should be used, can be used. Okay, substantive procedures. This is basically, I think all of us are experts in this. We do a lot of, when we say substantive procedures, we mean the test of details, or checking, vouching in our language, which is checking the underlying documents and then linking it with assertions. Substantive procedures will also include procedures on financial statement closure process. Please do not miss out on that. There are certain auditors who only perform the test of details on the financial statement line item, which is balance sheet and profit and loss, and there's nothing in the file on the financial statement closure process. Now, what is needed is agreeing or reconciliation of financial statement with the underlying accounting records, which could be the trial balance, or which could be other reports generated from the system, and then examining material journal entries and other adjustment. It is the journal entries I had given you an example also. The idea is to identify unusual entries and corroborate our understanding on those unusual journal entries. And obviously towards the end, once you have done your test of details, once you have done your substantive procedures, once you have done your financial statement closure process, there could still be, you would still want to corroborate your understanding, and for that you may want to perform final analytical procedures, and then try and corroborate your understanding basis the work that you have done. And if there are still differences, it would mean you still need to do more. You still need to develop your understanding at the financial statement level, drill down to the account balance level, or even at the disclosure level also. And then auditor cannot assume that an instant of fraud or error is an isolated occurrence. You need to be, you need to keep your eyes and ears open. So let's say if there is something basis your work, you identify an area where there was fraud. Let's say if there was some whistleblowing or some fraud in let's say a travel, let's say a vendor giving transport invoices, it is expected that the auditor has to think that this instance is not or cannot be in isolation. It could have occurred in many other locations also. So your files should demonstrate that uh, the detection of misstatement, the process that you have followed for detection of misstatement in other areas besides where you have found a fraud or found some uh, errors basis whistleblowing, the other areas, when the other population is not impacted. It is a but natural question your file has to. Can't dwell more on the need for documentation and the linkage of the process procedures that we perform basis at the assertion level and flowing from the planning. Again, I mean, if you look at this slide, things are extremely simple. You you identify, you do the risk assessment as per SA 315, assess your risk, and respond to risk as per 330. Well, it is easier said than done. This slide primarily demonstrate the linkage and uh, basically just trying to demonstrate, though in the slide it looks simple, but all of us know that there is a lot of effort that goes into this in terms of designing and implementing the response to the material risk management. Okay, moving on to the last slide, the key takeaways. Now, these key takeaways, the reiteration here is on on how would you document these aspects in the file. So, understanding the entity and its environment, this ensure that you have complete understanding of the entity, both for two aspects, both for performing a good audit and for documenting it for your own reference later on and for your necessary reviews. Assessing the risk of material misstatement and then materiality consideration. Obviously, everything boils down to materiality. Then understanding the internal control system and then the documentation. So this primarily gives you a small snapshot of how these two standards would look like. I'm happy to take up questions if there are any. Anilji, over to you for questions if any. No problem. Sure, sure. I'm holding.
Can you hear me, sir? Thank you so much.
Yes, sir.
Yes, sir. Yes, sir. Thank you so much, sir, for such a detailed deliberation on 315 and 330. Sir, I have received certain questions. If you allow me, can I go ahead with the question, sir?
Yes, sir. Yes, absolutely.
Sir, first question is, sir, how do we identify unusual events other than what has been provided to us by the company or anything identified by audit procedure? Any specific suggestion we should include?
Yes, yes, yes. No, this is a very good question. So let's say, what is am I audible?
Yes, sir. Yes, sir.
Okay. So let's say what is an unusual transaction while we were discussing on the journal entry aspect. I will give you some examples, some more examples. So let's say, all of us know that revenue occurrence of revenue is an important aspect and a significant risk for us. Now, what could be an unusual transaction here? So let's say normal transaction or a usual transaction is you credit revenue and then you debit AR. Now, unusual transaction could be, let's say, you are crediting revenue and then you are not debiting AR, or let's say you are debiting a expense head. This is something unusual, and you would want to know as to why debit is going to an expense head and not to AR. Because this is then a clear indication that the top line is moving up, and then the corresponding entry is sitting in the P&L account. So this is one example of something unusual sitting it. Obviously, how do you pick this up? You would pick this up by performing some data analytics, which could be performed through Excel also, or there are software also, but you could do it through Excel also by performing exceptional search.
Yes, sir. Yes, sir. Sir, how will we, as an auditor, evaluate risk in such a complex IT environment? Because in IT environment, most of the things are based on IT. So how we can calculate or evaluate the risk?
No, I think the IT environment makes the life easier for the auditor, and obviously the question is very, very valid as to how do we see the risk. I think the answer clearly lies in the fact that some expert needs to be involved who has probably a CISA or a DISA, who has an understanding of the IT environment. And once he gains the understanding of the IT environment, then this CISA or DISA would want to get comfort on the logic set in within the IT environment. When I say logic set in, let's say, for example, how is inventory valuation done? Now, there could be logic set in for overloading of overheads or overloading of certain other elements into the inventory valuation. So things like that. So once we have comfort on how the logics have been setting, and then this precedes, or let's say this succeeds comfort on the ITGC as I mentioned, which would mean that the automated environment is fine, the automated approval process is working fine. There is a proper audit trail. There is comfort on the access control. There is comfort on the change management in the automated environment. I think from auditor's perspective, obviously with the increase in the number of transactions of entities could be running into lakhs on a daily basis. How much can an auditor do? At the end of the day, auditor will also have to rely on the client's automated controls. So I think the answer is involve the CISA or a DISA who would do their procedures on ITGC and then procedures on the logic sitting in the system to give you comfort.
Yes, sir. Sir, most of the revenues are supported by invoices and sales order. What other steps should we do to address the professional skepticism?
Absolutely. No, I think from a sales perspective, sales order and invoices, this is not enough at all, if you ask me. Now, professional skepticism, there has to be some document which demonstrates the occurrence of the sales transaction. Now, what could be that document? That document could be receiving on the delivery challan, or anything which is a third-party document is a good document for you to substantiate that this sales had actually occurred. So let's say it's receiving on the delivery challan I mentioned, or it could be a receiving on receiving by the lorry, receiving on the lorry receipt. That is also a third party document. And one may also want to consider the payment received by the customer, and whether the covering letter of the payment receipt, or if there is a linkage between the payment receipt and the invoice number. So sometimes companies make the payment by writing against invoice number such and such, which is a clear demonstration that the transaction had occurred. So we need to go and think much beyond the documents sitting within, generating documents generating out of the company's IT system only. Anything which is a third party document will give a lot of comfort to you as an auditor and a signing partner.
Yes, sir. So can there be only test of control in any of the audit without substantive procedures?
No, I don't think so. It is mandatory to perform test of details. Only test of controls won't work.
Yes, sir. So then how do we ensure that the audit team address completeness test for responses to audit risk?
No, so completeness test would be twofold. One, at the account balance level, and when we say account balance level, let's say someone is performing audit test on revenue. So you may want to ensure that the ledgers that you have received to test the revenue, those ledgers tally with the trial balance. This will give you comfort on completeness, that the ledgers are complete, and from that ledger you may want to pick up your samples. The other completeness check is towards the end of the audit when you are performing financial statement closure process. I think one of the items I had mentioned was to check the financial statements with the underlying, which is the trial balance. That will give comfort on the completeness of the financial statement. So basically,
Yes.
whatever the auditor is signing, he needs to get comfort that it is the same thing which is sitting in the books of accounts of the company.
Yes, sir. So as a gist, sir, what controls can be put into place to regularly identify unusual risks and to mitigate them?
I think with the increase in the number of transactions, the audit teams should do more and more data analytics, primarily to identify exceptional items. Now, what is exceptional item, that they will have to think through, and that could vary from company to company. Like the example I had given you, where the credit is going to sales, but debit is not going to AR. So these have to be identified as to what could go wrong and what could be a problem in this. These have to be identified, and basis the
Yes, sir.
identification of this, use of the data analytics will help in identifying exceptional items.
Yes. Sir, what unpredictably procedures can be performed on receivables or advances or investments? Any example for relating to this, sir?
Okay, on receivables, when we say unpredictability procedures, so generally uh, we would send confirmations of year-end balance for receivables. Now, unpredictability procedure could be to seek confirmation of a particular invoice value. This could be one unpredictability procedure. So one is the year-end balance. The other is that year-end balance could constitutes of 10 invoices minus certain payments and all. So this could be one where you are seeking confirmation only for one or two invoices. The other procedures could be to let's say you may want to visit the AR or talk to them. Obviously, it will be unpredictable, but you need to route it through the client. You can't knock the doors of the AR directly. The client may not be expecting that you may want to speak to them or you may want to visit them. These procedures could be considered as unpredictable. The client will not expect that you will want them to talk to your customers.
Yes. Sir, as undocumented audit areas are considered as not audited, so on such occurrence, should the same be communicated to the client prior to the sign off?
Don't sign off. Absolutely agree. I mean, whatever you have not been able to get from the client, you can't sign. Because, if you look at the latest regulatory orders, they are very strict. in terms of what has gone into your documentation tool before you have signed off. So if you have not finished the audit, then you need to seek extension. Then you need to request the client to allow you extension of time. Or the audit should be planned better in a way where your documentation is complete for you to sign. Otherwise, it is taking a high risk now.
Yes. So last question. Sir, normally if we have to do a random inventory verification, we need to still inform the client. How do we ensure the unpredictability in that particular case?
See, you will have to inform the client, but don't give them the time period for them to fix anything. I mean, they know that you will surely visit them at the end of the year, or let's say on 31st of March. So let's say, should you want to verify the inventory on 28th of February, inform them probably on 25th or 26th of February. Don't give them time. Because why do they need the time if everything is updated on a daily basis, or let's say on every alternate day? Just give them 1 or 2 days, that should be fine. So unpredictability doesn't mean that you reach to the process owner directly. Unpredictability would mean that any audit procedure which client may not be expecting, and then you want to do that. So this is an audit procedure that you want to do, that you want to do a stock count, or you want to observe the stock count on 28th of February. This is an audit procedure, but you have to route it through client only.
Thank you so much, sir. Now we come to an end for today's webinar. We have gained a lot through your deliberation on both the two standards, SA 315 and SA 330. On behalf of Auditing and Assurance Standard Board of ICI, I extend my heartiest thanks to you, sir, for sparing your valuable time and enlightening all of us on various intricacies relating to both these standards, sir. Thank you so much, sir. Thank you so much.
Thank you, sir. Thank you.
Thank you so much.